Hi, Ashwin.
How are you?
How are you? It's been a while since we last came on this recording.
Yes, yes.
In this gap of time, we've not chatted.
Yes.
I've continued my work in my community around empowering and enabling and just raising consciousness. And the topic that has come up again and again seems to be around financial savvy. People who I'm associated with are regular people who don't have $50 million. We have a little nest egg that's been supporting our future and so on. And of course, we have to protect this, but we need that financial savvy to keep us going rather than making all those mistakes if we didn't have this intel, this knowledge. I hope today you can show us what to do, what not to do, because from our upbringing, from our the way that we've been raised, it's been keep your money in the bank, in a savings account, be safe, don't take risk, especially when you have not a lot of money. What say you?
Yes, Tessie, you took the words out of my mouth. You see, today's video that I prepared is a bit different. We are a bit concerned. Why? Because over the last 2 years since the pandemic, the economic fundamentals of the global economy have changed. Now, let me put it in a nice nutshell here. Over the last 2 years, central banks have printed billions and trillions of dollars. That has caused the value of money, the real value of real money to drop. Okay. And because of this money printing, inflation is now in the US at 7.5%, 7.55%, which is worrying. Because if you were a normal investor earning an executive salary, okay, paying for your mortgage, which costs about 5 to 8% a year, your credit card bills will cost you an overdraft fee of 24% a year, okay, and inflation 7.5%, and you put your money in a bank is less than 1%. What we're trying to say here and be concerned about is there is no creation, listen to this carefully, there is no creation of real wealth. You have your loans at 24%, your mortgage at 5 to 8%, and then you're putting your money in a bank, you're earning less than 1%. There is no real creation of wealth. And this is what we're going to talk about now. How can we create real wealth for people? It's not about having 5 million, 8 million. Whatever small wealth you have, as little as 50 to 100,000, how do we create, or say 100,000, how do we multiply that wealth? This is what we find in the market has been forgotten. Banks lure you to investments only to give you your principal amount back without any profit for yourself. They make use of your money. They say principal guaranteed investment. They give you back your money principal after 2 years. But one thing we forget, in the 2 years that you put your 100,000 in a bank or 200,000 in a bank, principal guaranteed, what profit have you made? No profit. Only the bank has used your money to make a profit.
So there's this saying, the rich make money work for them and the poor work for money.
Yes, let me tell you why.
There's another saying.
It's because the rich make it a point to be financially savvy and street smart. That is very important. In fact, I was telling you the other day.
So this is the topic of our discussion today.
In today's world, every single child, 15, 20 and above, needs to study and learn what is financial savviness.
Yeah, you see, I'm trying to establish a healthy relationship to our money, to money in general.
Yes.
The rich buy assets that would bring them profit.
Yes.
The poor seem to look out for liabilities they think are assets, but actually
very nicely you mentioned that. Let me explain to you.
Draining their income.
Yeah, let me tell you how. A rich man who has 100,000 will buy something that will increase his wealth from 100,000 to 150,000. A poor man will say, let me take this 100,000 and go and buy Louis Vuitton. Does Louis Vuitton increase the wealth? No, it's just show off. I can afford to buy Louis Vuitton. The poor, not the poor, the normal person should think this way. before buying a Louis Vuitton, I should take the 100,000, go and do something that will make it 150,000 and then buy Louis Vuitton. Can you see the difference?
So the lesson is delaying gratification, number one.
Yes.
Number two is knowing how and where to put your money so that it can grow for you. Unfortunately, there's so much noise in the market. There's so much pull and draw where you get caught in this eddy of, if you don't do what the majority are doing, you feel a little bit left out. You know what I mean?
The problem is this. The normal man on the street, if he gets $500,000, the first thing, go and buy a sports car, go and splurge on luxury items. Like I'm saying again, take that money and increase your real wealth first and then splurge, not first.
Yeah.
This is a big thing I've been noticing.
So this is the mindset.
Again.
So this is the mindset that I want to use as the space, that the platform where we begin everything. Your relationship with money has to be one where your money works for you rather than you take it and show off that you are rich when you're actually
when you show off, when you want to show off means you're a slave to money. When you want to show off, you're a slave to money. When you make your money work for you means, I don't want to buy anything. I want your 100,000 to work for me, to make it 120,000, 150,000.
And every time I earn money
becomes your slave.
Exactly. And every time I earn money from my little kitty, my coffer, then I get to feel rich, you know, and that's that relationship of growth that we must inculcate.
Yes. So like I was saying earlier, as kids, we've been very conditioned, every one of us, especially Asian kids. Do not borrow money, do not spend recklessly, do not invest recklessly, save as much money as you can, put your money in a bank. And the bank will give you like less than 1% a year. But unfortunately, we are concerned now that principle, I'm sorry, Tessie, no longer works. If you put your money in a bank for the next 50 years or 60 years, even though you are growing your principal, you are not getting rewarded well enough for the money in the bank because we have external circumstances like inflation, where the cost of goods and services and food and everything is costing 7.5% more. And then what money do you make?
I need to stop you there and ask you, because every time you work with a financial institution, advisor, or a bank, they will ask you, what is your risk appetite? Your risk appetite of staying safe, or very low appetite, or a medium one where you dare to keep a basket, or high risk where you're kind of like a punter or a gambler. So immediately they assess you, and then they know what to do with you. So if you fall into the retail investor bracket, like most of my associates are, where you can have maybe 100,000 to 500,000 US dollars to play with, you generally need to protect that wealth and do smart things with it.
Yes.
You know, rather than just put it in the system.
Yes, and also I must mention, when you mentioned 100 to 500,000, one thing the investor must realize, number one, inflation is very high and the risk-reward ratio with banks in the market is not enough. Whatever banks pay you as a risk-reward ratio for your money is not enough to cover the cost of inflation. Number two, if you have that kind of money, 100 to 500,000, honestly, you have to be prepared for a risk level of at least 20%. Otherwise, it's not going to work. At least 20%. I'll elaborate later what we are doing nowadays with clients with $100,000, and it's exciting. Of course, it's more risk. It's 20 to 40% risk. But what we are doing in a nutshell is we are creating for our clients real wealth of about 3 to 5% per month. That's interesting, very interesting. I'll come into that later. So the purpose of the video is to say, look, the economic fundamentals have changed. We have inflation. We have the prices of everything going up. So if you stick to your current plan of saving money, putting in a bank, not being reckless, it is not going to create, you have enough money to spend every month, I know. But over the next 10 years, you will not create that, what we call real wealth. And for you to leave a legacy behind for your children, for whatever, you need to create real wealth. And I tell you now,
I need you to slow down so that we can understand the components.
Yes. So real wealth meaning you got $100,000 in the next 10 years. can you make at least 20% a year on your 100,000? That's
Okay,
what
let's slow it down further.
Yeah.
In the beginning, you have the very low risk category where people want to be able to go into their savings account and see that their hard cash is there and they have access to it, they have control over it.
Yes.
So that's the category where your returns are probably going to be at its lowest. And you're saying that inflation far exceeds the earnings from
so
there.
now inflation is 7.5%. So you should be making above 10% a year to cover the cost of inflation.
That's where I want to connect the dots, because what needs to shift in our mindset to enable us to be freed up enough to take that leap forward, still have control over our money, because we make the decisions. It's still money that we can feel and touch and control. But we are making far better decisions. And high yielding, taking high yielding positions.
In a nutshell, if inflation is 7.5%, so any investment that you do with anybody, 3 to 5% a year is not good enough. It's negative yielding. That's a nutshell. So forget about 3 to 5% a year. You have to start thinking 10 to 20% a year, at least 10 to 20% a year.
What I'm saying is, when you transition from low risk appetite to medium risk appetite, where we are, we still maintain control over our assets. We still have the power to make decisions, to drive what we are doing with our money, rather than losing that control over to banks and other financial institutions. Let me tell you the bad news.
When you say low risk appetite, that low risk appetite right now doesn't exist, because you have got inflation at 7.5%. So you are spending everyday money. You are spending money every day, paying 7.5% more for your goods and services and food and everything. So if you're going to make 3 to 5% a year, technically you are in negative territory.
Yeah, especially when you're paying mortgages and interest on mortgages and interest on credit card bills.
Exactly.
You know,
so
and inflationary costs,
and you're only
invisible costs.
You're spending all this money, you're only making 3 to 5% a year, it's negative yielding. So mindset, that is the mindset that must shift. Now we are in high inflation environment. What we hope sincerely is that in the second half of 2022, once the supply chain comes back to normal, we sincerely hope inflation backs off and drops. That will be good for
everybody. That's out of our control. Tell us what to do that is within our control to raise our yields.
What we have done right now is this: for conservative clients, we are working on a 50 to 100,000 investment, where we give you 10 to 20% on a conservative level, on a lower risk level. We are in the safe radar zone, because inflation is 7.5%. You are getting 10 to 20% a year. You are still better than inflation, higher than inflation. And going one step forward, what we have done is to introduce something called high frequency trading, which hitherto was only meant for people with $5 million or $10 million. And we have toned this down scientifically for a minimum of just $100,000 US. Now, let me tell you how we're helping clients. With $100,000 US, provided you can take a paper risk appetite of 20 to 40%, because it's high frequency. We are making for our clients on the average, we are making for them 3 to 5% a month. Actually, it's even more. For the month of March, in the last 15 days, we made for our clients 8 to 10%. I'm just giving you an indication. From 15 March to now, to the end of March, 15 days, we have made for our clients 8 to 10% in total. So when I say 3 to 5% a month is being safe, under promise, over deliver. So we are doing this. We are the only persons to do this, because if you go in the market, high frequency trading requires $20 million. And our private clients do high frequency trading for $5 million. So for the first time, we have brought high frequency to the retail level for a minimum of just $100,000 US.
Okay, slowing it down again, you have one package where you ask for between 50,000 and 100,000 US dollars.
That's
and
normal investing. Normal investment.
And on that, you deliver an average of 20% per year.
Yes.
And then the other one, which is slightly more high risk, you expect 100,000 US dollars, and on that you deliver how much?
for high frequency trading, it requires minimum $100,000. Now, if you
Yes.
can afford a paper risk level of 20 to 40%, this is the extreme case, okay? Paper risk, not realized risk. We are talking 3 to 5% per month, okay? But in real terms, from 15 March onwards, when we started to do this, we have delivered for our clients about 8% already.
Per month.
We have delivered our clients 8% in 15 days.
Per trade.
No, total profit, 8% in 15 days. Okay, not
Now
per
tell
trade.
me again.
For
tell
15
me again.
days, we have generated 8% for our clients. Our benchmark is 3 to 5% a month.
Tell me again about control and safety and not, letting go of
Yes.
your own decision making.
We will trade for you, but you just open the account in a broking in a broker, online broker, and the money is in your name, in your account, and you give us the written consent to trade on your behalf. That's all we do. And
if you didn't,
trading, same thing.
And if you didn't do this, and if you left this money in a bank, or
Yes.
bought a unit trust, or I don't know, bought maybe other asset classes, what would you say?
A bank will pay you less than 1% a year, and then a unit trust will pay you between 5%, 6%, 5 to 6% a year. Can you see? Everything is not so good. If you buy a bond, it will only give you 3% a year. And let me warn everyone out there, please, in the next 24 months, please do not buy any bonds, because when interest rates climb globally, which they are, okay, and US is going to have at least another 2 or 3 more rate hikes this year alone, all your bonds are going to depreciate in real value. So please, I repeat, in this kind of environment of high inflation, please do not buy bonds. Even though your bank tells you buy a bond, please do not buy bonds.
Okay, the other thing is currency and the domicile. Many of my friends are investing mainly in Singapore, Malaysia, and Hong Kong near to home. What say you?
That's fine. I mean, we are looking at Hong Kong, Malaysia, and Singapore as well. But at this point of time, we are not so bullish on Malaysia. Singapore, we have our own fixed plan of what to do. Hong Kong as well. Our biggest focus on where the expansion is actually the US and Europe. Whether market up or down, regardless of direction, whether Ukraine war or whatever, we have made, let me say this publicly now on this video, due to the Ukraine war, we have made more money for our clients in the US and Europe since the war started. Because, very simple, it's not about market direction, it's about volatility. When market moves up and down, it gives us the opportunity to create new wealth. So I say again, volatility is your friend, creates new wealth. It doesn't matter if market goes up or down. It doesn't matter. As long as it moves, and it all makes the market move.
So am I right
down 100
to
points,
say,
there's money to be made. If the market
am I right to say that you make your decisions what to buy, when to buy, based on what presents to you the best yield, and not what's popular to buy?
What we call optimal risk-reward ratio. You see, Tessie, when you look at the market every day, down 100 points, up 500 points, we are beyond that. We have already done our research using our algorithm called data mining. Based on data mining, no matter where the market goes, we know which company to buy at which price level. Let me just tell you this. We have a very advanced, mature level. We are beyond the market up, market down. We are now, I want to buy this company, which is the right price level, because I know I'm going to make a profit. We are at that kind of level now. We are beyond your market up, market down. Shall I buy, shall I sell? We are beyond that. We are beyond that. We already
and
have
also the noise.
Yes.
Also the noise that comes from my friends, from CNBC, from Bloomberg, from, my friends are saying this, I read this, I saw that.
We have an advantage over anyone. I'm not boasting, but I'm speaking facts. Because we have something called data mining. And to add that, it's 75% machine, 25% human. It's data mining. And this data mining looks at things from the top. We are beyond daily movement of market up, market down. We don't care. We can't be bothered. We already know what to buy. We already know what to do. It's about when to buy and when to take profit. So it's a
So I
different.
have a final question. You know, I work with women in women's development. You know, there's property development. I work in people development, and especially my passion is around women's development. And for women, in my opinion, is important for us to be financially savvy, financially stable, financially independent, financially secure.
Yes.
Now, what is your word to women in particular about this topic?
Very, very interesting question. I love this. I've been saying this so much. I've been talking about this to people so much. I feel women in today, before you talk about making money, very important even for kids and women. You have to, no bargain, no negotiation. You have to be financially savvy. Meaning, you have to have an interest in finance a little bit because it's for your own good. If you don't have interest in finance, how are you gonna handle money, make it grow for you? You have to have some interest in finance. And then you have to see on a normal level, if you have a Google, your computer, your handphone, just go to Google and you can see what's happening. NFTs are going up, NFTs are going down, people are buying more Bitcoin. So you get the feel, oh, what is the market doing? People are buying stocks or selling stocks, or people are buying Bitcoin, or people are doing what? So you get that sense. And then of course, I still say, you need a solid financial advisor to hold your hand and tell you exactly what's happening. Okay, it doesn't have to be us, it can be anywhere else. But when you have a financial advisor to appoint him, you have to have a criteria of what you're looking for. You're looking for medium-term trading, short-term trading, high-frequency trading, all kinds of things. So it's very, very important for all women who are in this world to be financially savvy. You have to.
I think it's very important to break away from this codependence with our partners, codependence on our jobs.
Yes.
And even for men, I'd say, not to be dependent on the salary or the paycheck.
Yes. So,
or, a business income,
you
multiple streams of income.
Yes. So what I'm trying to say is this: if you're earning an executive salary every year, like you said, have multiple streams of income. Diversify your salary base into other things, so that if anything goes wrong, you've got different streams of income coming in. Just by putting your money in the bank is not going to create any real wealth. I'm not looking down anybody.
And here's some rhetoric that I get when I say this. I don't have enough. So the sense is I have this much, and I'm
50 to 100,000.
To
us, not have enough means minimum at least $50,000. That's for the lowest category of investment.
What they really mean is I don't want to lose it.
You see, this is where the financial advisor comes in. If you have a small amount like 50,000, you have to have a very nimble financial advisor who can understand what to do, when to do, and how to do, because that 50,000 can be lost in 1 month. So
what you're doing is pretty interesting when you say a yield of 5% to 8% a month.
That is a high risk trading, but yes.
Yeah, that sounds pretty interesting.
And like I said, in reality terms, we have now generated 8% in 15 days. So we are looking to higher, of course. But again, having said that, even we talk about 8% in 15 days, we want to go higher. We are also subject to external conditions like war. If the war worsens, of course, we will back off our trading and lessen our trading. But if the market overcomes the war, of course, we can make more money. We are actually looking at 4% a week. Exactly. We say 3 to 5% a month, but actually in real terms, we can generate 4% a week.
So this is where that relationship to money comes into play.
Yes.
You need to have a very healthy relationship to money. Like, this is going to work for me, rather than, being so emotionally attached that anything that happens to it, I get so uptight and I react rather than I make good decisions.
Yes. And one thing in Asia, I'm very sad to say, people fall into traps to buy mutual funds. And mutual funds only pay you 5 to 8% a year. And listen to this. So you buy a mutual fund, you make 5 to 8% a year. But your inflation is 7.5%. So in real terms, you are negative to only up 0.5%. So you are happy you make 7% or 8% from a mutual fund, but the cost of things you're buying is 7% or 8% higher. You are,
but not only that,
no real wealth is created. That
but
is
not only that, we have no control over that money once we buy.
Correct.
That's
Because you
the thing.
give it to your bank and they buy into a mutual fund, and then 1 year
Yeah.
later, or you either make or you lose.
So this is where your product is interesting, because
Yes.
you keep your control.
Yes.
You learn
We
and
control
be
it for you.
educated.
We control. We are the control.
Yeah, yeah.
Not a
There's
bank,
this
not a faceless
partnership.
mutual fund. We are the control.
We have this partnership with you. We are in control of our own decisions.
Yes.
We know why we're doing it, when to do it.
Yes.
You know, so I think this whole part of staying educated
Yes.
is very well looked after.
Because like I'm trying to say again, and I repeat it for the last time before we sign off, bonds at 3% a year are not going to work for you, because once inflation comes in and once interest rates go up, the real value of bonds is going to fall. So you buy a bond, the bond value going to fall, and you're going to make what? Your dividend on your coupon on the bond, 3 to 5% a year, is not going to cover the bond fall. So you're going to lose money buying bonds. Secondly, you buy a mutual fund, you're going to make only 5 to 8% when inflation is at 7.5%. You put your money in the bank, you get less than 1%. So I've already given you three things that will not work. In this current economic climate, these three things I mentioned, bonds, mutual funds, and putting your money in a bank, in a savings account, is not going to work. So,
okay. Thank you for today, Ashwin. How do we contact you?
I can be contacted at on WhatsApp, bit.ly/algotrader. Okay. And you have a YouTube channel, bit.ly/algowealth. Please watch our videos. We are very passionate about educating people, just like in this video. And our YouTube channel is actually our report card, our resume, whatever you call it. So we can be contacted on WhatsApp if you have any queries. And of course, you can email us, ashwin@ppchk.net. And one more thing, you can contact us on WhatsApp as well, bit.ly/algotrader, and give us your email, and we can send you a free algo research ideas newsletter for free. Okay,
thank you so much for today.
To know what we're doing and what kind of things we are thinking of.
Very, very valuable information, and from a different perspective as well. So thank you. I'm grateful for your time.
Thank you, Jessie. Thank you, Vanshika.
I'll see you next time.
Thank you.